The stock market has been going great so far, but it's reaching a critical point. The price of the stocks is getting higher and higher compared to the real company earnings, mostly fueled by the interest rate cuts and the new government election. The good times of low interest rates of the last 15 years are behind us because despite lowering them, we're too close to zero to be able to make a dent in the long term. And our dear US national debt is currently over 120% of GDP at about $36 trillion. So, after 15 years that made the US stock market into an invincible investment, what if the next decade were to be a lot less exciting? There is a growing possibility that the stock market in the next decade might take a break and leave us scratching our heads wondering where all the gains went. So in this video, we're going to take a closer look at why the next 10 years might not be the smooth sailing that we've gotten used to. I want to start with something optimistic, even though I'm a pessimist by nature because I'd rather have good news than bad disappointments. So we are going to start by seeing the positive that we can catch from history, and you'll see that this is actually going to be really encouraging. This is the graph of the rolling 10 years returns of the S&P 500. Rolling 10 years means that whatever year you look at in the graph, the return you see is going to be the average annualized return of the previous 10 years. So for example, if we take 2022, the last year in this graph, the value is around plus 13%. This means that if you invested 10 years before, in 2012, you'd have averaged 13% per year in that decade from 2012 to 2022. Now the good news is, most of the time, no matter when you invest, within 10 years you're going to have positive returns. But still, you see that there is a lot of volatility depending on when you jump in. You can get from plus 22% per year to minus 5% per year. In 2009, the average rolling return is minus 3%, for example. And this is because if you invested 10 years before, in 1999, you'd have had both the dot-com bubble of 2000 and the great financial crisis of 2008. You'd have been in the middle of the famous lost decade. You know, what I don't understand is, people freak out now when the market goes down like 6% in August for a couple of days. And I don't know, I just think people are spoiled because of the last 15 years of incredible growth. Anyway, if you take the 20 years rolling returns, so you imagine to keep the investment for 20 years, things look much better. There is still volatility, but you can see that there was never a moment where you'd have started investing and have a negative return in 20 years. Still, investing in 1999, you'd have had like 4 to 5% return per year for 20 years, which is not exactly great. In 30 years now, and obviously in the future it can be different, but in the rolling 30 years returns, the S&P 500 has been truly like a metronome. Really predictable. 10% yearly average before inflation, no matter when you started investing. With a range that is quite narrow, from 8% in the worst 30 years to 15% in the best ones. This is, by the way, one of the cornerstones that I have when I think as an investor. When I think of time horizons of 5, 10 or 15 years, for me, they're really short term. I don't see 15 years as long term. 15 bad years can always happen. In 30 years though, it seems like we always manage to overcome bad cycles. Now this is an article from the Federal Reserve Board, written by Michael Smolyansky. It's already a year old, but the content is still up to date. It's called End of an Era: The Coming Long-Run Slowdown in Corporate Profit Growth and Stock Returns. So let's go and read the abstract. Here, I show that the decline in interest rates and corporate tax rates over the past 3 decades accounts for the majority of the period's exceptional stock market performance. So lower interest rates, meaning companies and people can borrow money cheaper, and lower corporate taxes, meaning companies have more money left to invest in their growth. Lower interest expenses and corporate tax rates mechanically explain over 40% of the real growth in corporate profits from 1989 to 2019. In addition, the decline in risk-free rates alone accounts for all of the expansion in price-to-earning multiples. And this about the price-to-earning ratio is also interesting because, remember, when the stock market grows, it can be because companies actually grow, or also just because people have higher expectation for the future. So you have a so-called PE ratio, or price-to-earning ratio of a company or of an ETF. If the PE ratio grows, as it happened in the last 15 years, it means that the price of the stock is growing much more than the real earnings of the company. So we've been inflating the market prices in the last 15 years. Then he says, I argue, however, that the boost to profits and valuation from ever-declining interest and corporate tax rates is unlikely to continue, indicating significantly lower profit growth and stock returns in the future. So let's see why. At page 10 of the study, there is this table. Look at panel A. Row 1 shows that from 1989 to 2019, real net income grew almost twice as fast compared to the period 1962 to 1989. 3.8% versus 2%. So you might think that companies have managed to accelerate earnings growth in the last 30 years. Row 2 shows though that the EBIT, or earnings before interest and tax, actually grew about the same in both 30 years periods. So if the earnings before interest and taxes grew the same and the net earnings grew much more in the last 30 years, it means that the higher growth of the last 30 years was driven entirely by the decline in interest and tax expenses since 1989. And to reinforce this, you see that also EBITDA, or earnings before interest, tax and depreciation and amortization, was also the same for both periods. Now, row number considers dividend growth. This is also interesting. Dividends grew at a real rate of 3.3% per year from 1989 to 2019 versus 1.1% from 1962 to 1989. In other words, firms did what they are supposed to do. They distributed their higher profits to shareholders in the form of dividends. This occurred even as firms in the last 10 years started doing more what Warren Buffett suggests to do, namely buying back shares instead of giving away dividends. And it's also clear from here that for both periods, the rate of dividend growth was somewhat below the rate of income growth. So it may be tempting to assume that this exceptional performance of the stock market over the last 3 decades will continue forever, but the analysis indicates otherwise. The study says that both stock returns and corporate profit growth are very likely to be much lower in the future. And this is because interest rates and effective corporate tax rates can't really go much lower than the level they reached in 2019. So let's start with interest rates. In December 2019, the benchmark 10-year Treasury yield was at 1.9%, and going below this level is hard. Why? Assume that inflation averages 2%, which is the Federal Reserve's target level. If a 10-year Treasury yield also averages 2% in the long term, equal to inflation, it would mean that the US government will forever be able to lock in 10-year funding at an average real cost of 0. This is quite extreme to believe. And even if interest rates do in fact fall below the levels of 2019, this would probably not be good news either. If interest rates remain that low for a long period of time, it would be harmful for corporate profits and stock returns because economic growth would struggle to gain momentum in the long term. And then we have corporate tax rates. They're also unlikely to fall much further. The Inflation Reduction Act of 2022, for example, imposed a 15% corporate minimum tax. In contrast, just a few years earlier, the Tax Cuts and Jobs Act reduced the corporate tax rate from 35% to 21%. With the ratio of US debt to GDP near all-time highs, if you don't want to damage the economy too much, you're going to have on one side corporate tax cuts from Trump, and on the other side you're going to have that Elon Musk does his job well and improves the efficiency of the government. Because otherwise the deficit is going to grow more and more, and so is the debt. An optimistic scenario would be for interest rates and corporate tax rates to remain close to their 2019 levels over the long run. This is the best that can happen. But in this scenario, corporate profits would only grow by as much as EBIT, which in the last 60 years grew at an average of 2.4%. Certainly not 10% like we're used to see the stock market grow. So interest rates and corporate taxes that influence the real growth of companies don't have a great outlook for the next decade. But you could say, well, the price of the stocks can still grow even if the real earnings don't. And that would mean that the PE ratio is going to grow. So let's see why it's hard. Even PE multiples in the future are unlikely to expand much beyond what we've seen in 2019. PE multiples can only expand in 4 cases. 1, if risk-free rates decline. 2, if risk premiums decline. 3, if people expect higher earnings growth. And 4, if payouts to shareholders increase. So let's see these 4 cases separately. From 1989 to 2019, price-to-earnings ratio grew only because of the decline in risk-free rates. Since risk-free rates are not expected to fall much below 2019 levels, PE multiples can't continue to expand in the same way. The earnings growth expectation can't get higher either. We've seen before why. And if the expectation for earnings growth decreases, stock market performance will also suffer as a result. This means that we're left with 2 ways to increase PE ratios. 1 is the increase in payouts to shareholders, and one is the decline in risk premiums, or risk premia, if you know Latin and you want to say it right. Higher payouts to shareholders are going to be hard because companies need to fund investments and retain cash. Risk premia might decline, but it's more like wishful thinking. An optimistic scenario, therefore, is for PE multiples to remain close to their 2019 levels, just like interest and corporate tax rates. In this case, again, stock returns could only grow at the same rate as EBIT, around 2% per year. For the last part, I want to show you the market perspective from Vanguard. Vanguard publishes these outlooks regularly, and they basically tell you how much they think that different equities will perform in the future. According to Vanguard, US equities will give between 3.2% and 5.2% per year, with value performing better than growth, because growth is so overvalued right now, and the rest of the world will perform better than the US with 7 to 9%. Fixed income is going to be high, with US aggregate and treasury bonds between 4 and 6%. I don't know. I doubt it's going to be so high, but that's what Vanguard thinks. Now, the outlook doesn't look well, and everything makes us think that the next decade is not going to be a good decade for the stock market. Still, every single year, everybody says that US is overvalued and a crisis is coming, and still the US keeps delivering overperformance compared to the rest of the world. So, who knows? Maybe this decade will also be a surprise. One thing for sure, if you want to make the best financial decisions, you should definitely subscribe to this channel. It's free and you get new videos every week on investing. I wish you a great day, everyone. As always, I'll see you in the next video. Ciao!